All right, welcome everyone to Value Investing Live. Today we are pleased to welcome our guest, Bill Nygren. Bill has been a manager of the Oakmark Select Fund since 1996, Oakmark Fund since 2000, and the Oakmark Global Select Fund since 2006. He is also the Chief Investment Officer for U.S. Equities at Harris Associates, which he joined in 1983, and a Vice President of the Oakmark Funds. He served as the firm's Director of Research from 1990 to 1998. The Oakmark Funds are a mutual fund family that utilizes a long-term value investment approach. Their investment philosophy centers on the belief that superior long-term results can be achieved through investing in companies priced at a significant discount to what Harris believes is a company's intrinsic value, alongside some strong growth prospects and owner-oriented management teams. For the Oakmark Funds, assets under management totaled approximately $49 billion at the end of June. Harris Associates was founded in 1976 and serves as the advisor to the Oakmark Funds. They also manage U.S., international, and global portfolios for institutional and high net worth investors worldwide. Including Oakmark, their assets under management totaled approximately $86 billion as of the end of June 30th. For all of you out there in the audience, please feel free to post your questions in the live chat throughout the presentation, but keep in mind that we are going to hold those until we actually get to the Q&A at the end. And without further ado and any other statements from me, I'd love to hand things over to Bill and we can go ahead and jump into the presentation.
Thanks, Graham, and thanks, Guru Focus, for giving me this opportunity. And I'd also say, more importantly, thank you for the content that you so consistently make available for investors. I know many of us at Oakmark follow Guru Focus. It's a great way for us to keep track of what our peers and competitors are doing and to understand the investment rationale for some of the positions they take that are different than ours. So what I'd like to do during our time today is we'll spend first half hour or so going through a presentation talking about what we do at Oakmark, some of the ways we differ from other value investors, and then I'd like to save most of the time, a good half hour at the end of it for questions, because I generally find with an audience like this, the presentation gets more interesting when I'm more focused on the things that you're most interested in. So let's get started. At Oakmark, our investment philosophy, as Graham indicated, relies on three criteria, and we look for all three to be present in any company we consider investing in. We want to buy at a significant discount to our estimate of intrinsic value. We want companies that are expected to grow per share value over time, at least as fast as the S&P 500. And we want to invest with management teams that think and act like owners. So when they face difficult decisions about how to invest their capital, how to handle an acquisition opportunity, or maybe even the opportunity to sell their own company, we want them to behave like an owner, not like a professional manager. And it's only when all three of these criteria are present that we're able to take advantage of what I think is our biggest competitive advantage, and that's our very long-term time horizon. At Oakmark, we invest looking forward about 7 years. We try to forecast how a company will be different at the end of the 7 years than it is today, how investor perceptions might change, and what that would mean for the stock price. I like to refer to what we do at Oakmark is we take a private equity perspective to public equity investing. So when you think about what private equity investors do, they want to buy companies today that they think they can change and at some point in the future bring back to the public market when it's easier for investors to understand the full business value of the company that they've acquired. We want to do that, but within the public markets, we don't want to have to be involved in changing out management teams. We want to invest with people that are already oriented to maximize long-term business value. So let's talk about how we think about determining intrinsic value. There are lots of ways that you can talk about value. Some of our peers in the industry would talk about like price to book value or PE ratio as the primary determinants of business value. We like to think a little more broadly than that. And to us, full value is the maximum price an all-cash buyer could pay to buy the entire business and still earn an adequate return on their investment. So with this an important consideration for us, we spend a lot of time following what's going on in the private market. When a company is acquired, especially by an all-cash buyer, we keep a database on those acquisitions, and then we try to compare public companies to the closest peers that have been taken private and use those to help us figure out what we think the business value of the public company is. I think it's important to say that at Oakmark, we work very hard to not get boxed in on any specific business value estimate. There are some companies, like banks, that we think book value is a good indicator of what the business is worth. There are some traditional consumer companies that PE ratio might be a good indicator. But then there are other companies that are at different stages of their life cycle where we have to think more creatively about the right business value benchmark. And importantly, we give our analysts the freedom to identify the benchmark that they think best estimates value for any company that they're looking at. So it might be a price to subscriber, a price to sales ratio, and it would differ across different industries that we're looking at. The second thing we talk about is growing per share value over time. I think a lot of times people mistakenly think that value investors are kind of destined to own only subpar businesses whose best days are behind them. And each year they lose a little bit of market share, they lose a little bit of their competitive advantage, kind of what Ben Graham called the cigar butt companies. We have a very different view of value at Oakmark than that limited view of value. We think those companies can be valuable at the right price, but we think that's far too constraining a universe. And one of the things that we look for is a company that the combination of dividend yield and annual per share value growth at least matches what we expect to see for the S&P 500. So when you think about value, a lot of times people set up what I think is a false comparison of saying value versus growth. To us, growth is an attribute of value, and it's necessary for an analyst to look at what the growth prospects are for a company to help determine what the appropriate multiple is. So we will not constrain our universe at Oakmark to only those below average companies that happen to sell at very low PE ratios. One of the most important parts of this is, how do you find value? How do you find something that's cheap and still growing faster than the market? A lot of times it's based on what management does with free cash flow generation. So we might find a company, say the S&P is growing earnings at 5 or 6% a year. We could have a company that's only growing sales at 2 or 3%, but is a big excess cash flow generator. I think of the banks as an example of that today. And it's important to us that management consider the whole array of opportunities of how they can invest that cash flow, including things like share repurchase. So we want them to be thinking about per share metrics when they think about maximizing value and maximizing growth. Oftentimes our companies will be a business that's growing at 1 or 2% a year on the sales line, but the share base is shrinking 5 or 6% a year, so it's actually growing earnings per share faster than the S&P. Third, managements that think and act like owners. We spend a lot of time looking at what management's economic incentives are, their personal incentives. How are their pay packages determined? Do they have to own a lot of stock? Have they chosen to own stock? Do they have options positions that will benefit them at the same time they're benefiting us as outside shareholders? Are there incentives tied to things like return on invested capital that we think benefit outside shareholders, as opposed to what I would call more like a professional management rather than an owner-oriented management, where they might be incentivized to just grow the sales line of the company, become a bigger enterprise, and the management might be focused just on growing the scale of the company so that the importance of their job importance of their job grows and therefore their pay package grows. We would much rather be invested with a management team who will make more money if the stock price goes up and we benefit. So we spend a lot of time looking at, is a company generating capital or does it have to invest capital to achieve their sales growth forecasts? And we make assumptions about how that capital is utilized that all go into determining our estimate of intrinsic value. We want managements to think when they have to raise capital about the fair value of the company and be reluctant to issue shares when they think their stock is trading at less than fair value, and maybe opportunistically would want to sell shares when their stock is above fair value. Of course, if it's above fair value, we would hope and expect we wouldn't be a shareholder. It's important to us that management gives evidence that they're willing to do those things that benefit us as an outside shareholder that might not make their job a bigger job. So something like investing capital in share repurchase when that's the highest return opportunity, to us is a good example of a management team that's behaving like an owner. So over the past decade, I'm sure everybody in the audience is well aware how difficult it has been for value investing. Been a great market if you're a growth investor, 17% a year annualized for the past decade. In a market where you've only been able to earn a few percentage points by a year owning a bond, 17% compounded for a decade is a big deal. And it's not that value's done poorly. As you see the green line on here, the value index is up 10% a year, which is really good versus inflation. It's helped people meet their personal financial goals. Their real capital has been growing. But relative to growth investing, there's been a big gap, and it's led a lot of investors to question whether or not value investing is even a style that's going to work going forward. So 10 years ago, the person who invested $1 in the Russell Growth Index has twice as much capital today as if the investor had put that money into the Russell Value Index. We don't think that kind of spread is sustainable. So what has caused this has been a big valuation gap between growth and value today. So this is a chart that I like that compares the PE ratios of rapid growers to the lowest PE stocks out there. And if you look at the history of this from the 1950s to about 2000, it's typically between 2 and 3 times, sometimes up to 4 times. So if the cheap stocks are selling at 10 times earnings, the high growers are usually between 20 and 30 times earnings, sometimes as much as 40. That number got really crazy if you think back to 2000, the internet bubble. It went up to almost 10 times. You see the line breaks there because for a year, the fastest growers actually had negative earnings. And it's interesting, we're seeing that again today. I saw a statistic that if at the beginning of the year, you'd bought an equal weighted portfolio of all companies with over $1 billion of equity market cap that had lost money in 2019, you'd be up something like 60% year to date. So clearly it's a market that we think has become speculative and is paying a very high price for growth. You could see after 2000, that index came right back down to the 2 to 3 times range that it's typically been at. And that last spike up that we've seen over the past couple of years has been this very painful period for value investors where anything growth is going up and value just isn't. We're back up to 9.4 times, which is an all-time high. So the typical low PE stock today is about 10 times earnings, and the most expensive growers are selling at almost 100 times earnings today. So why has that happened? Part of it, as I said, we think is speculation, but there are some fundamental reasons. Rate declines increase the value of future growth. I've said only half sarcastically, if interest rates are zero, the value of the future is infinite, and that clearly benefits growth investors. But PE ratios, we think, have overreacted to interest rates. Another reason is GAAP accounting has failed to capture the value of intangibles And as the economy is shifting to businesses that really create intangibles and earn returns on those intangibles, you have to give a little more thought to, is GAAP accounting doing a fair job of estimating business value? So first, let's start with the lower interest rate. The higher stock's multiple, the higher its duration is, and the larger that value increase is as rates go down. So if you compare where we were 4 years ago, interest rates were about 180 basis points higher on the long end than they are today. And if you use the PE ratio as an imperfect measure of the duration of a company, you can take that PE ratio times the change in interest rates to approximate what the theoretical PE ratio change should have been. So a cheap stock 4 years ago was at about 14 times earnings, a 1.8 percentage point change in interest rates. You would say that PE ratio should have gone up about 25%, all else equal. The high growers, on the other hand, started at 39 times. They would go up, multiply that by that same 180 basis points. You would say they should have increased about 70%. So the low PE stock should have gone from 14 to 17, and the high PE stock should have gone from 39 to 66. But we know that's not what happened. Let's look at Apple first. This is a company we owned in the Oakmark Funds for a long time, since after the crisis in '08. The PE ratio averaged about 13 times over that period. We thought it was a pretty easy value argument. Better than average business, selling at a below average multiple. We sold our Apple stock last quarter as the PE ratio on Apple has skyrocketed. 5 years ago, it was under 11 times earnings. It started the beginning of this year at just under 23 times. And a couple months ago, it had gotten up to 39 times earnings. Oddly, this has happened during a period where Apple's business has been maturing, and it's harder to forecast as rapid growth as back when we owned the stock when it was selling at a much lower multiple. We still think Apple's a great business, but it's hard for us to justify a tripling in the PE ratio and now selling at more than twice the market. So in the 4 years from 2016 till beginning of 2020, Apple's PE ratio went up by almost 50%. We thought that was appropriate, but in the past 9 months, that PE ratio has now over 5 years increased 260%, another like 60% from where it was in January. We had a hard time understanding or justifying that, and that's why the stock's no longer in our portfolio. But this revaluation of caused by lower interest rates has skipped past a lot of companies. Bank America, an important holding for us, 2016 to 2019 averaged 12 times earnings. Today, Bank America sells at about 13 times earnings, so it's only gone up by 1 multiple point, much less than the 25% increase in PEs that we would argue lower interest rates should have caused low PE stocks to increase. So let's look again at the duration effect, or the effect from lowering interest rates on growth stocks and value stocks. 4 years ago, when the real underperformance of value started, the rapid growers were selling at about 39 times earnings. The low PE stocks were at about 14 times, so about a 2.5 times multiple, not too unusual by historical standards. Compare that to what we would have thought should have happened based on interest rates, that increase from 40 times to over 60 times for growth stocks, and value stocks should have gone up 14 to 17.5. But what actually happened is the rapid growers went up to over 100 times earnings, and the value stocks, despite lower interest rates, PEs actually fell from 14 to 11. So if these stocks went back to what we think fair value would be based on interest rate changes, so comparable valuation to where they were in 2016, adjusted for rate changes, it would say that there's a little more than a third downside in the rapid growers, but at the same time, the cheap stocks would have to go up by more than 50% to hit the 17.5 times multiple that we think would be deserved based on lower interest rates. So we think we're at, again, a point in time, much like we saw back in 2000, where valuations are incredibly stretched and there's an opportunity for value investors to make money. At the same time, we think growth investors could see some decrease in their capital. So let's move on to the discussion about intangibles. If you think back to the time of like Graham and Dodd, everything was focused on book value because there was a strong tie between book value and economic value. Back at the time I was in school, right before I got started in the business, there was a very strong correlation between book value and stock price. In fact, if you knew the book value of a company, you could guess about 71% of where the equity value should be. So the average stock traded at a small premium to book, and as the X's demonstrate on that graph, correlations were pretty tight. And mean reversion was a great strategy back then. You picked the stocks that were selling above book, you avoided those, bought the ones that were below book, and you just waited for a reversion to the mean. And that was enough to make money because investors were shunning cheap stocks. If you look today, there's almost no correlation between stock price and book value. In fact, the correlation is only 14%. So knowing the book value of a business today does you almost no good in trying to estimate where the stock price will trade. And that's because of the value of intangibles. If you look back again 45 years ago, 83% of a stock price could be explained by its stated book value. Today, that's only 13%. And it's because things like brand value, talent of your employees, intellectual capital, the infrastructure for a global scale business are all intangibles. Building all of those are expenses for a company. They go through the income statement, and book value gives you no clue about what those values are. So we like to talk about the intangibles of value investing. We think the growth and importance of intangibles, it's more likely to continue growing than it is to reverse. So we think an investment strategy that artificially limits its investable universe to just cheap stocks based on book value is one that's likely to disappoint because reversion to the mean on book value is something that no longer makes economic sense. So our approach to finding value has been consistent over time. We've readily walked away from metrics like price to book and PE when we don't think they represent value. And if you look like in Morningstar style boxes, other than small cap, we own pretty much all of the style boxes. We've got a value argument for each of these names, but a name like Citi or Ally Financial that everyone would agree is a value stock because it's below book, it's low PE, we think they're very cheap. But then we've got companies like Hilton or TE Connectivity, the electronic auto parts company. They trade closer to market multiples. Morningstar would call them core stocks, but we think that these are businesses that are much better than the market and deserve premium. So we think the value case is just as strong on those as it is on the names that are more easily identified as value. And then in the growth sector, names like Netflix and Gartner, where we think GAAP accounting does an injustice, those are names that you expect to see in growth portfolios. But if you value Netflix based on $1,000 a subscriber, like cable TV used to be valued, or like HBO was valued, it looks cheap, only forecasting out subscriber growth for a couple of years. Or you look at a company like Gartner, the IT information source, they are investing so much in Salesforce and customer acquisition cost right now, trying to obtain what I would call supernormal growth. And that runs through the income statement. We think of that as investment spending, and capitalizing and depreciating it like you would a fixed asset that you could touch or feel makes Gartner, instead of selling at 40 times earnings, look like it's selling at a below market multiple. So another example, let me quickly talk through our largest holding, Alphabet. At first glance, it doesn't look like it's a super cheap stock. Mid-20s multiple, 19 times on the S&P. It would be easy for a value investor to say, well, it's a great company, but the market's already recognizing that, and just move along to the next potential idea. But we think GAAP accounting does an injustice to valuing Alphabet. So let's start with the business YouTube that I'm sure everybody uses. YouTube has made the decision to not aggressively monetize its viewership so that it can maximize growth in viewers and increase its moat in video, in providing video direct to consumer. If you valued hours watched at half the rate that they were being valued for cable TV networks, it would be worth a couple $100 a share for Alphabet, and yet YouTube contributes very little capital or very little income today. Also, the cash on the balance sheet, almost $200 a share. Everybody knows it's difficult to invest your cash today to earn any kind of yield in the bond market, so it's not contributing to income, but it's a value of a couple $100 a share. And then think about things like autonomous vehicles, Waymo, Google Cloud or Alphabet Cloud. They're spending about $6 a share that reduces their earnings to invest this venture capital, which we think is building substantial value for Alphabet. If you make these adjustments to Alphabet's PE ratio, to both the price you're paying, by subtracting off the other assets and then adding back the losses from venture capital, you'd see that the basic business, the search engine business, is selling at less than a market multiple today. We can argue about how big the premium Google search deserves, but I think it's very difficult to make an argument that it's a below average business deserving of selling at a lower than market PE multiple. And recently you hear a lot of people saying, there are investigations into whether or not Alphabet is a monopoly and will they have to break up the company. I don't think that's the best outcome for Alphabet, but because our valuation is based on these separate businesses, I think Alphabet would move toward our estimate of business value if they did have to break up, because then the market would be forced to separately value their venture capital investments, separately value YouTube, and the company might be more willing to use its capital to repurchase shares or some other way to deploy it that would be reflected better in the income statement. And it's interesting, you could ask, so in this time that you're saying that high growth companies are getting these massive premiums, it's interesting to us to look at how is Alphabet being priced relative to that high growth universe. If you go back just a few years ago, 2017, Alphabet's stated PE was actually at a premium to the high growth universe. And now that that universe has gone up toward 100 times earnings, you can see Alphabet's relative PE has come steadily down versus its other high growth peers. And we think that's a real opportunity. It's funny, the Russell Index, which separates out growth from value, is actually calling Alphabet now a hybrid name, part value, part growth. And I think that's ironic given the high growth characteristics that Alphabet has, that there is so much value in the market today, or so much price in the market given to companies that are high growers, that Alphabet is no longer considered a pure growth stock. So winding up, I'd say despite the current headwinds, or maybe more accurately stated, because of the headwinds that we've endured, we think value investing is in a really good spot today, with an opportunity to not only continue delivering good real returns on capital, but to also see a reversal of this growth value spread, which we believe gives a high likelihood that value investors are likely to outperform growth investors going forward And we think the Oakmark Fund is extremely well positioned should that eventuality come true. So with that, I don't have anything further to add, and would turn it back to Graham now to see what kind of questions the audience has about intrinsic value, relative value, margin of safety, things we do at Oakmark, current environment, anything you'd like to talk about.
Awesome. Well, thank you so much for that great presentation, and we'll go ahead and jump into these questions now. It does look like we have a decent amount piled up already. We'll go ahead and start up at the top of things. Question regarding in a bubble, people are not aware that they are in a bubble. They only realized after the bubble has been punctured. So currently, do you think we're living in one without realizing it?
I guess I'd take a little bit of issue with the idea that you don't know you're in a bubble when you're in it. I think it would be fair to say that there are a lot of investors, probably the ones who are buying small businesses at high valuations today, that think they're buying large cap companies, or they are actually purchasing large cap companies, but they're not even getting a big business for what they're paying. They may not realize they're in a bubble. But I can tell you 20 years ago, when Oakmark Fund was really underperforming in the dot-com bubble, we knew we were in a bubble. Advisors were begging us to own some tech companies so that they could justify continuing to invest in Oakmark. Cab drivers were telling me that they knew how to invest better than I did. And I think we're seeing a lot of those things happening again today that you know are not sustainable. I don't think it's sustainable that investors continue to invest in a bond market that's giving a negative real return. Historically, short-term rates have tended to be about in line with inflation, long-term rates higher than that. And today, the long bond isn't even yielding what the Fed's target for inflation is. It's funny when you look back at 2000, what popped the bubble. Even having lived through it and seeing the bubble pop, I couldn't tell you what specific event happened that popped that bubble. It was just like the rubber band expanded too far and finally it had to snap back. And businesses aren't helpless to help drive their stocks toward fair value. Companies with overvalued securities can make acquisitions of undervalued companies and use stock for it. Undervalued companies can start redirecting their capital massively towards share repurchase. Those steps force this reversion to the mean and would help to collapse PE multiples back more toward their typical ratios.
Definitely. So, looks like next question here. I think we've touched on this a decent amount through the presentation, but just to reiterate some of those points, how do you estimate the intrinsic value of a company that has long-term earnings power and earnings growth?
So specifically what we do at Oakmark, we have our analysts forecast out all three of the financial statements for a company for the next 2 years, and then we apply a growth rate to both earnings per share and business value per share by looking at whether the company's generating free cash flow or needing capital to meet the growth expectations. We look at comparable companies in the market as an indicator of what business value, what might be an appropriate PE multiple. I mentioned earlier, we look at acquisition multiples. We look at long-term discounted cash flow multiples, and kind of triangulating and looking for when we don't get those three different ways of looking at value, kind of honing in on a certain similar valuation point, and then going back if a PE ratio looks a lot higher value than an acquisition multiple, we'll go back and take a look at it. We don't want to just take a naive average of those multiples. So we make an estimate of what PE ratio we think is appropriate for a company with its risk and growth characteristics 2 years from now. Then we discount that back to today. And then we look for companies that sell at 2/3 or less of that estimate of value.
Definitely. Thanks for that clarification. And Do you think value investing in the style of Buffett is no longer valid with quantitative easing and highly informed investors?
Uh, it's funny. I don't think the information level that investors have was ever the reason that value worked. I think it was more human psychology and the difficulty that investors have looking long term when the short term looks cloudy or even worse, negative. Uh, I think value investing, properly defined, has to work. The issue could come in, if your definition of value investing is buying below average businesses that are losing market share, selling at low PE multiples, low price to book multiples, I don't think you're guaranteed a reversion to the mean there that often made value investing work like into the 70s and 80s because GAAP accounting did a better job of reflecting business value then than it does today. But if you can get past GAAP accounting and you're looking at true measures of how business value is being created, I definitely think value investing works every bit as well today as it did any time in my career or in Buffett's career.
Gotcha. And we'll go ahead and lump a couple of these questions together here. We already briefly covered Google there, but any thoughts on Cisco or Chevron as good companies to buy?
We spend all our time looking at the companies that we end up owning, and my opinion on a company that we don't own, I don't think is, unless it happened to be something that we've given very serious consideration to, I don't think my view is any more interesting than anything you could hear from any other investor on CNBC or elsewhere. So I don't have a comment that's useful on Cisco or Chevron.
Definitely. Appreciate that. And looks like this question, Howard Marks has a way of knowing where we are in the boom bust cycles. Do you have any thoughts on that type of methodology?
Howard Marks and Oaktree is one of the, I guess you'd call them competitors or peers that we admire a lot. And I regularly read Howard Marks' material. He was out with something new this week that I enjoyed reading. I think his book is a great book. And it's a great way to help investors kind of ground themselves and help understand what it is that you're really basing your investment decisions on. I don't think at Oakmark that any of us would say that we think we are better than anyone else at guessing where we are in the economic cycle or predicting when the next downturn would be. We'll look backwards a lot at like what normal margins might be, what kind of normal sales levels cyclical companies have, and we use that to inform our estimates of future earnings and business value of companies. But we're not in the business of what I would call a top-down analysis where you start by saying, where are we in the economic cycle? Which are the industries you want to be in based on that view of the economic cycle, and then having your investments follow. I think the real difficulty of being a macro investor is investors always start with, you have to have a strong point of view on the macro world. And I think that's the easier part to develop. The second part is you have to be in a non-consensus position. And I remember back in 2008 when everybody was saying, based on the decline we'd all been through, you had to be a macro investor. You had to have a macro point of view. And then these investors would say they'd come to the conclusion that we'd just been through a severe recession and that growth was probably going to be a little bit slower than normal going forward, which was right down the center of what consensus forecasts were. And if your macro forecast is consensus, you really don't have anything to base an outlier view for your investments, which is what you need to be able to identify undervaluation. If your view on everything is just consensus, then you're going to come to the same conclusions all the other investors are.
Definitely. And let's see. Looks like this question, our viewer noticed Capital One is a huge customer in Snowflake, and just wondering if you have any thoughts there, or if Capital One is accessing anything through that relationship that you can give away.
I don't have anything that would help someone figure out Snowflake's valuation. One of the things I would say that we like in Capital One, and one of the reasons we own it, in addition to its very low PE multiple, is we think that they have done a better job in investing in their IT infrastructure. And as you know, oftentimes when you're making those IT investments, you're running two systems simultaneously, and a cost-saving IT investment can actually increase your costs short term. Capital One, we believe, is in a position where they've developed a better mousetrap on their IT systems, and it's one of the reasons that we have higher growth forecast for Capital One than other investors do, because we expect their costs to be coming down as they migrate more to the internally developed IT system that they have, which we believe is a competitive advantage. How much of that's due to Snowflake, I'm afraid I can't help you.
Well, thanks for that. Let's see. So, with regards to Bank of America, do you have any thoughts on the upcoming election, second wave of the pandemic coming in, or a late stimulus not coming to 2021 actually affecting the banking industry?
Well, the first answer to that is when you think about how Oakmark invests, we're basically trying to estimate what a company is likely to earn 7 years from now, and then what kind of free cash flow or capital needs will they have during those 7 years, and then figure out the returns that capital is likely to either add or subtract to their organic growth rate. So in terms of how the next quarter or next year, or whether the stimulus comes before the election or sometime in 21, it really has a pretty trivial impact to what a 7-year out business value estimate would be. And then I would also go back to the comments that I made when we were talking about macro. If you want somebody who's got the experience of doing value investing for 35 years and can talk about the ups and downs of that and what we've learned from it, I'm your guy. We've done that. That's what we've done at Harris Associates. I did that on my job prior to Harris Associates and Oakmark. But predicting the election, predicting when a stimulus is likely to come, when the recovery will start, our point of view at Oakmark, we don't believe is any better than anybody else's. We think our advantage there comes from our ability to look past all of those short-term things that might be influencing stock prices much more than they're influencing long-term business values.
Definitely. We do appreciate the honesty there. And how does an all-cash buyer translate to discount rate used in determining intrinsic value?
Well, first, the reason we look for an all-cash buyer is we want to make sure that it's not a company that's gladly issuing its stock because they believe it's grossly overvalued. A mistake that a lot of people made back in 99 and 2000 was they used acquisition prices in internet acquisitions, which were basically exchanges of funny money. You had one stock that was selling at 10 times intrinsic value, and it was acquiring somebody that was selling at 5 times intrinsic value. So the acquisition made sense to them, but in terms of a metric to look at what other companies were actually worth, it wasn't very helpful. So for 20 years, or actually longer, we've said we want to be really careful when we look at an acquisition where the currency that's being used is the equity of the acquirer, that we aren't falling into that same trap of an acquirer that's anxious to issue their stock because they think it's overvalued. Uh, I think it's hard to translate that directly into a discount rate. I think it's easier to translate an acquisition price into a PE multiple that's appropriate or a price to sales multiple. When we think about discount rates and how to figure out an appropriate rate, we start with what do we think the inflation rate is going to be. You can look at the Fed, you can look at long-term tips to get a market view on what inflation is going to be. Investors want a premium to that, even without taking risk. So for a treasury, typically in a 2% inflation environment, treasury would sell at 3%. A corporate bond would sell at a premium to the treasury, maybe something like 4%. And then for an equity, depending on its risk level, it would have to sell at some premium, or it would have to earn an expected return at some premium to what you could get on the bond because the equity is in a riskier position. So we start by taking what we think an appropriate corporate bond rate would be, and then look at the risk parameters of the equity that we're looking at investing in to figure out how much riskier is it or less risky than the average equity, and set an appropriate discount rate based on that. So we rely heavily on the fixed income market. And in days like this, where the fixed income market we think is overvalued, on where we think long-term the fixed income market should be.
Gotcha. And what would you say is the best criterion to measure intrinsic value for a highly growing company?
Well, I guess a big part of that is how confident are you of future growth? You know, I've often said that I don't think growth and value are at the opposite ends of a continuum. Growth is a piece of business value. I think the bigger difference between growth and value investors is how far out are you willing to forecast that growth? We get really queasy at Oakmark if we have to project growth more than 7 years into the future to get to the point that a business we're considering investing in would have a below average multiple. And it's not just that it's not that we think we're uniquely inept at forecasting growth beyond 7 years, but it's the history we bring to the table there and the difficulty of forecasting what a business is actually going to look like 7 years from now. I mean, I've done this long enough to see investors in mass come to a decision that the newspaper industry was one of the few industries that you could safely forecast 20 years into the future and justify high premiums for. I've seen that in the pharmaceutical industry before patent cliffs became such a problem. When you live through that a few times, I think you become much more sensitive to how difficult it really is to forecast more than 7 years into the future. We own companies like MasterCard and Visa. We've owned them a long time. They've gotten pretty close to our estimate of business value. Today, you can't quite get to a below market multiple forecasting out 7 years of expected growth. There's a lot of capital going into fintech. So far, they've partnered with MasterCard and Visa. But to get really comfortable that you're buying those names at a big discount to business value today, you have to be confident that 15 years from now, those businesses are still going to be the leaders that they are today and still be growing much more rapidly than the market. That's a bet we just don't want to make, especially when we've got the opportunity to buy leaders in industries like banking or some of the consumer products that we own that we aren't even paying a double-digit PE for.
Understood. And what is the overall size of your investable universe, and how much of that universe do you think meets those tenets and requirements?
So in the Oakmark Fund, most of what we do is large cap, but we prefer the definition of large business instead of large cap, because then we aren't in that model you're in today where like over the past year, 40 businesses have become large cap companies that on average just have sales of $1 or $2 billion. And we definitely don't want those names being in our investable universe. So we think about the 250 largest companies in terms of sales, net income, and shareholders' equity. Obviously, those are like three overlapping circles. So the largest 250 in three different areas doesn't get you 750 companies. It gets you 300, 350. And I would say about a third of those are on our approved list today. And then we sort through those, the portfolio managers in the Oakmark Fund sort through those 100 or so companies to the half or so that we think make the best portfolio, that gives us the best portfolio risk return profile, making sure that we don't own like 50 banks at a time like this when almost everything in financial services looks cheap.
Definitely. And on that note of risk, how would you say you factor it into your value estimations?
Well, one way we look at it is the risk level that we assign for the company, and we get there by looking at what the bonds trade at. We look at our own assessment of the management team, our own assessment of the quality of the business, and the higher we believe the discount rate deserves to be, the lower the PE multiple that will give us that we're targeting a stock price to sell at. So there's a very direct comparison between the risk level we assess and the multiple we expect the business to trade at. And this can make a really, really big difference. We have companies that we think fair value might be 12 times earnings. We have other companies that we think fair value might be 35 times earnings. The 35 times would be higher growers that we think are lower risk. Not that high growth is normally low risk, but the combination of high growth and low risk. And the ones that we think barely deserve double-digit multiples would be the businesses that are higher risk businesses, maybe higher leverage on the balance sheet, and businesses that are more commodity oriented, hard to develop an edge versus the competition, and those would be deserving of lower PE multiples.
Gotcha. And to switch gears briefly for a second here, one of our viewers is wondering what type of credentials the Oakmark analysts have.
Our analysts generally are finance degrees, often an MBA. I would say half or more of our analysts also have CFAs. We have hired more recently straight out of undergrad. We'll hire interns over the summer, generally students that are enrolled in business programs, preferably finance, strong passion for the investment business, and we'll bring on a couple of those every summer, and probably half of them get asked back, and that would be the path toward becoming a junior analyst at Oakmark, and then experience is what makes a junior analyst become a regular analyst for us. I think it's important for people looking at getting into the industry to take a strong accounting background. If you're interested in value investing, you're going to be spending a lot of time analyzing financial statements, and that's a whole lot easier if you've got a really strong working knowledge of accounting. I think you should be reading all kinds of stuff about successful investors. Back when I was in undergrad, I was spending most of my free time reading books from the library about successful investors and trying to understand which ones appealed to the way I thought about the world, and helping to form the way that I thought was appropriate for investing. And then I'd encourage you to find that approach to investing that you think will have yourself not fighting with your own brain all the time. For me, I'm a value investor when it comes to being a consumer, and I'm that same person when I'm buying stocks. I think it's difficult if you're the kind of person who wants to buy things that are faddish and you don't mind paying top dollar, and then you try to work for a value investing firm. You're constantly at odds with yourself and fighting. So you find out what approach best suits your own personality, and then try to find a potential employer that is using that type of approach to build their portfolios.
Awesome. Thanks for that. And do you look at tangible book rather than book value now, or do some of your observations from earlier apply to tangible book too?
Well, we do look at both, but I mean, intangibles today are generally not coming from those areas that we think create business value. For a branded consumer company, intangibles aren't, the sum total of their advertising expense for the past 3 or 4 years. It usually just means they paid more than book value when they made an acquisition. So we don't spend a lot of time looking at intangible book when we're looking at, say, a consumer products company. If you're looking in the banking industry, the intangibles might give you a good idea of how much above tangible book the acquiring business, the acquirer, thought that a business was worth when they purchased it. But then you get back to the basic banking business tends to earn something like 12, 13% on tangible equity. And the fact that they paid more than book for something years ago and that created an intangible doesn't really help you in terms of estimating future earnings for the bank. So I would say our focus is more on book value, but we do look at intangibles for clues about what some of the businesses might actually be worth.
Gotcha. And are there any markets around the world that you're seeing great growth and value that you think people should be looking at to get involved in?
Well, if this interview today was with David Harrow, who's our lead portfolio manager on the international side and our chief investment officer of Harris Associates on the international side, he would tell you he believes the opportunities outside the United States are greater than they are inside the United States. I think that's partly because international markets have underperformed the U.S. markets recently, and it's partly just his bias that that's what he looks at all the time. As the person who does this on the domestic side, I'm almost always going to tell you I think the opportunities are great on the domestic side, and I don't spend almost any of my time trying to unearth values on companies located outside the United States. I invest my personal capital in the funds David manages because I think he's a great investor, and those funds are just as likely to beat their indices long term as ours are on the domestic side. And I think they face the same kind of difficulty the past 5 years that we did, that growth was increasing in price more than value was, and it's created that same kind of spread between growth and value, which we think will regress to the mean. So I think the opportunities are great both in the United States and outside the United States, but I'm not prepared to tell you there are better chances to invest your money away from the United States.
Definitely. And it looks like we are getting down to the end of things here as far as our timing will go. We do still have a bunch of questions left, but we'll see if we can pick one out here to kind of end things off on. All right, here's a good one for us to end on. Bill, if you wouldn't mind, can you describe a time when your analysis of intrinsic value was wrong, and where do you think that error came from?
Yeah, unfortunately, we don't have to go back too far in time to find an example where we were very wrong. I would highlight GE as probably one of our biggest fundamental mistakes over the past couple of years. GE is a stock. Oakmark Fund is probably one of the only fund companies in the United States that owned no GE stock up until very recently. So back in the late 90s, when Jack Welch was managing GE and it was selling at 50 to 70 times earnings, we always looked at it and said, we don't understand why it sells at such a high price. It's basically a combination of financial services companies and industrials. and we can buy very good industrials, very good financial services, and not pay much more than 10 times earnings. That lasted up until the Great Recession about 10 years ago, and GE stock came down dramatically in price. We had a change in management at GE, and we thought with that change in management was coming much more a focus on long-term per share business value, on cash flow rather than reported earnings, on willingness to sell businesses when they thought that sale could increase per share value. And we welcomed that change at GE. It was very much a different attitude than what we'd historically found difficult for us to think there was alignment between outside shareholders and GE. What we did not understand was how aggressively GE had used GAAP accounting to pull forward earnings, especially in their power business, that were coming from their long-term sales and service contracts. We knew there was a shortfall on earnings relative to cash flow, but we were able to convince ourselves that management's explanations of that made sense. And to us, when GE stock was selling in the 20s, we thought it was worth in the 30s. We thought it was a good value acquisition. Subsequently, GE has reported very disappointing numbers in power. Our estimate of the power business today is trivial relative to the importance of aviation and healthcare, both of which we think are great businesses, and through this difficult period for GE, have performed very well. GE's brought in new management from Danaher. We have tremendous respect for Larry Culp. We think he is a great manager of a diversified company like GE, and will focus on long-term per share value growth. So typically at Oakmark, when we were that wrong on fundamentals, we'd sell the stock. We don't want to think that the driver who put the bus in the ditch has to figure out how to get it out, or that suddenly we have to be really right on a business that we've been so wrong on. But our estimates of business value for aviation and healthcare aren't much different today than they were several years ago when GE stock was 3 times the stock price. And we think based on our estimates there, we can justify the stock selling at a much higher price. And you don't need to believe that we are right on our estimate of power today, which is quite small, especially compared to what we used to think power might be worth. You don't need to believe we're right on power to believe us that GE is selling at a significant discount to business value today.
Gotcha. Well, thanks for that. And thanks for taking the time to join us today and give that wonderful presentation and go into some more questions with our guests here. We really do appreciate you coming out and spending the time with us.
Thank you, Graham. Thank you, everybody on the line, for taking time out of your busy day to listen to this. And again, at Guru Focus, thank you for the great content that's on your website every day. Take care, everybody.
Definitely. We really do appreciate it. And for those out in the audience, if there was any part of this presentation that you missed, there will be a full recap available here on YouTube, as well as on our website at gurufocus.com. We hope that you enjoyed the presentation today. Go ahead and subscribe if you're not. Drop us a like on the video. We really do appreciate it. And without further ado, we'll go ahead and close things out here. Thanks again to Bill for joining us, and we hope everybody out there can stay safe and stay healthy.